An hourly rate of pay is the amount of money an employee earns for every hour worked. This rate provides a direct measure of the compensation for labor and varies significantly based on the industry standards, experience levels, and regional economics. For example, a retail employee may earn a different hourly wage compared to a skilled technician, reflecting the varying demands and skills required in the respective fields. Hourly rates are influenced by several factors, including industry standards, levels of experience, geographic location, and labor demands. The economic conditions and company size also play a significant role in determining pay scales for different positions. Higher levels of education or specialized skills can lead to increased hourly rates. Additionally, market competition often forces companies to adjust their pay rates to attract and retain talent. Understanding these factors helps in negotiating competitive salaries and ensures fair compensation within the labor market. Hourly rates vary significantly across different industries due to factors like demand, skill level, market conditions. For instance, technology sectors often offer higher hourly pay compared to retail or food service industries where rates tend to be lower. Understanding these differences is crucial for job seekers and employers alike. In 2023, the average hourly rate for IT professionals was approximately $50, while retail workers averaged around $15 per hour. This disparity highlights the importance of industry choice in determining potential earnings. Legal regulations and hourly pay. Hourly pay is governed by various legal frameworks, including the Fair Labor Standards Act, FLSA, which sets standards for minimum wage and overtime pay. Employers must ensure compliance with these laws to avoid penalties and maintain fair labor practices. Certain states may implement stricter minimum wage laws and federal standards, necessitating careful adherence to local regulations. Employers must regularly review payroll practices to ensure alignment with both federal and state laws regarding hourly compensation. Failure to comply with these legal requirements can lead to significant financial liabilities, including bank wages, back wages, and fines. Understanding these regulations is crucial for both employers and employees. Common misconceptions about hourly rates include the belief that hourly workers earn less than salaried employees. In reality, hourly workers often have the opportunity to earn overtime, which can increase their overall income significantly. Another myth suggests that all employers must pay the minimum wage, but exceptions exist based on job type and location. Gross remuneration refers to the total earnings received by an employee before any deductions such as taxes, insurance, and retirement contributions. This can include base salary, bonuses, overtime pay, and other allowances, ensuring a comprehensive overview of an employee's compensation package. Gross remuneration comprises several key components, including base salary, bonuses, overtime pay, and benefits such as health insurance, retirement contributions. Each element contributes to the overall compensation package, impacting employee satisfaction and retention while fulfilling legal and financial obligations. Gross remuneration is total earnings before any deductions. It can be calculated by multiplying the hourly rate by the total hours worked, including overtime pay, bonuses, and any other compensations. Understanding this calculation helps in financial planning and forecasting. For example, if an employee works 40 hours at a rate of $20 per hour, the gross remuneration is $800. If they receive a $200 bonus, total gross remuneration will be $1,000 for that pay period. Gross remuneration represents total earnings before any deductions, including taxes and benefits. In contrast, net pay refers to the amount employees receive after these deductions. For example, if an employee's gross remuneration is $5,000 and tax deductions total $1,000, net pay would be $4,000, underscoring the significant impact of deductions on employee income. Taxes significantly reduce gross remuneration, impacting take home pay. For instance, income tax deductions may range from 10% to 30% of gross earnings, depending on the tax bracket and local legislation. Additionally, other deductions such as Social Security and Medicare can further decrease the net amount received by employees. Awareness of these deductions is crucial for financial planning. Ultimately, understanding the full effect of taxation allows employees to make informed decisions regarding job offers and salary negotiations. Overtime refers to any hours worked beyond the standard work week, typically exceeding 40 hours in the United States. Overtime pay is usually calculated at a rate higher than the regular hourly wage, compensating employees for the additional hours spent working. Eligibility for overtime typically depends on job classification, earning rate, and hours worked. Positions such as hourly workers are usually eligible, while salaried employees in executive and administrative roles may not qualify. Understanding these distinctions is crucial for both employers and employees in ensuring fair compensation. Employers must adhere to the Fair Labor Standards Act, FLSA guidelines, which stipulate overtime payment for hours exceeding 40 in a work week. Exceptions exist for specific job types and salary thresholds, necessitating careful review of individual contracts and workplace policies. Overtime pay is typically calculated as 1.5 times the employee's regular hourly rate for hours worked beyond 40 in a week. For example, if the employee earns $20 per hour, their overtime rate would be $30 per hour. Calculating overtime accurately ensures compliance with labor laws and fair employee compensation. Overtime laws vary by country and state, but generally require employers to pay employees at least 1.5 times the regular rate for hours worked over 40 in a week. Regulations mandate clear documentation of hours worked, ensuring compliance and protection for workers' rights. Extended working hours can lead to significant health issues for employees, including increased stress, fatigue, and higher risk of chronic conditions. Studies reveal that excessive overtime correlates with mental health challenges and decreased productivity, ultimately impacting both employee well-being and organizational performance. Gross sales represent the total revenue generated from sales of goods and services before any deductions such as returns, allowances, or discounts. Understanding gross sales is crucial for evaluating business performance, setting revenue targets, and making informed strategic decisions regarding pricing and inventory management. Gross sales are influenced by several factors, including market demand, pricing strategies, marketing efforts, seasonal trends, and customer service quality. For instance, a competitive pricing strategy can attract more customers, while effective marketing campaigns increase brand visibility, leading to higher sales volumes. Tracking gross sales is essential for understanding overall business performance and revenue trends. It informs strategic decisions, helping identify peak sales periods, and supports budgeting. Regular monitoring enables businesses to make data-driven adjustments, identify growth opportunities, and assess the effectiveness of marketing strategies. Gross sales refer to the total revenue generated from all sales transactions before any deductions, providing a clear view of sales performance. In contrast, net sales account for returns, allowances, and discounts, reflecting the actual revenue a company retains, which is crucial for understanding profitability. Analyzing gross versus net sales offers important insights into sales efficiency and operational effectiveness. Businesses need to monitor both figures to identify trends, potential issues, and opportunities for improvement in sales strategies. By comparing gross and net sales, organizations can enhance financial planning and budgeting processes. This analysis aids in recognizing how deductions impact revenue and assists in setting realistic sales goals. To increase gross sales, businesses can implement several strategies such as optimizing pricing models, enhancing marketing efforts, and focusing on customer retention. Leveraging data analytics to understand customer behavior and adjusting inventory based on demand can also drive sales growth. Additionally, creating promotional campaigns and improving product visibility can attract new customers. Understanding pay structure is crucial. Key elements include hourly rates, gross remuneration, and overtime calculations. It's essential to recognize the distinctions between gross and net pay and how each aspect influences overall compensation and sales performance. Maintaining awareness of labor laws and market trends aids in